And for those people that don't know what the tax benefits of holding real estate are, Larry, what would you say the tax benefits are?
Yeah, so there are a few, and forgive me, I was grabbing the cord here. I want to get this light back on. I look like one of those anonymous people that don't want their face shown and just giving out information. But in any event, the tax benefits that come along with buying and holding real estate. Number one, we hear this a lot, depreciation. So I like to describe depreciation really in layman's terms. And some of my tax friends will get on me because I'm not going to use technical jargon here. But depreciation is kind of a gift from the IRS that says, hey, you purchased this asset. We're not going to allow you to write off the full price of it right away in this first year. You have to chop that up into 27 and a half if it's residential, 39 chunks if it's commercial. So you take the purchase price, you divide it by one of those numbers. So let's assume it's residential, right? You got a $500,000 property, 27 and a half years. The IRS says, thank you. We're going to give you an $18,000 deduction every year. That's an $18,000 paper deduction. That's not actual money that's going out, right? So your cash flow, it really helps because your cash flow is intact, but you've got $18,000 that you can take in without any tax implications. Yeah. That's the fun part. And plus you got your other operational things, right? Property tax and some of those other things that happen. So that's the first thing. The second thing from and this is less of a tax, but just more of a appreciable asset perspective. One of the best things that real estate does for you when you own the asset, it allows you to an extent to hedge against inflation. What happens as the value of the of things go, or excuse me, as the price of things go up, the value of the dollar, you can usually raise rents in tandem to help you hedge against that. And then again, as things currently stand, because there are tons of proposals right now by President Biden, but you can pass your asset on to the next generation after something happens to you, and they receive what's called a step up in basis. That means you bought the property at, let's use a $500,000 mark again. You bought the property at $500,000. Over the time that you've owned it, it's now appreciated and it's worth $750,000. At the time that you pass away, your family members receive that step up in basis. They now have a property that's worth $750,000. If they decide to, they could sell it with limited capital gain exposure. So that's one of the fun things that happens on the tax side with real estate.
Yeah, it's funny because in other words, like if you make $18,000 of positive cash flow a month, that's money in your pocket. But then if you have $18,000 of depreciation, that wipes out, to my understanding, the entire $18,000 that you made. And exactly. It makes it so that you don't pay any taxes on that. So then towards the end, we'll get into some more advanced tax strategies like accelerated depreciation. And not only we can wipe out some of your cash flow, but it could also wipe out some of your income from your business as well too.